Somewhere in this city, right now, someone with a 9-figure net worth is borrowing money. Not because they can't afford what they want, not because they're struggling, because borrowing is cheaper than paying taxes. And they know something that most people never learned. And architecture, unlike accident, can be studied. It can be mapped. Every wall, every beam, every load-bearing rule can be traced back to a decision someone made. In a room, at some point in history, a decision that still echoes through every paycheck, every asset sale, every inheritance today. This video is that map. Not a complaint about unfairness, not a call to outrage. Just the architecture itself, laid bare the 4 pillars on which the modern fortune is built, and quietly maintained. By the end, you will understand exactly how a $500 million net worth can generate a tax bill smaller than a school teacher's. You will understand why that is legal, and you will understand why almost no one without serious capital can replicate it, not because the law forbids it, but because the law requires collateral most people will never hold. Let's begin where all of it begins, with a single, deceptively simple idea about what income actually means. To understand this, you need to understand one foundational principle of how taxation actually works in most developed economies. You are not taxed on what you have. You are taxed on what you earn, on income, on realized gains. If you never sell an asset, if your wealth simply grows on paper, the government cannot touch it. This is the foundational loophole that makes everything else possible. Wealth that is never converted into income is wealth that is never taxed. And the ultra-wealthy have built entire financial lives around that single insight. Consider the asymmetry this creates. A nurse, a teacher, a software engineer, their income is taxed the moment it is earned. It is withheld before they ever see it. There is no delay, no negotiation, no strategy available to them. The system taxes labor in real time. But an asset owner, someone holding shares, real estate, a private business, experiences time completely differently. Their wealth can compound for 10 years, 20 years, an entire lifetime without triggering a single taxable event. The growth is real. The purchasing power is real. The ability to use that wealth as leverage is real. But on paper, to the tax authority, nothing has happened at all. This single distinction between earning and holding is the foundation stone. Every other strategy in this video is, in some form, an extension of this one idea. Find a way to access the value of an asset without technically realizing it. Stay on the holding side of the line, and the tax bill simply does not arrive. It sounds almost too simple to be the basis of a multi-trillion-dollar planning industry. But the simplicity is the point. The wealthiest families in the world do not need exotic offshore secrecy or illegal concealment. They need patience, collateral, and a willingness to never sell. Here is the mechanism. Let's say you own $500 million in company stock. You need $50 million to buy a private residence, fund a venture, or simply expand your lifestyle. You have 2 options. You can sell the stock, triggering capital gains tax on the profit, or you can use the stock as collateral and borrow against it from a bank. If you borrow, the loan is not income. Loans are not taxed. You receive $50 million in liquid cash, tax-free, and your underlying asset continues to grow. Look closely at that split screen for a moment, because the gap between those 2 outcomes is the entire strategy in miniature. Selling $50 million of stock at a long-term capital gains rate plus state tax in a high-tax jurisdiction can easily cost over 1/3 of the proceeds. The seller is left with roughly $33 million in usable cash and, just as importantly, $50 million less in invested assets going forward. Borrowing the same $50 million leaves both numbers untouched. The full $50 million arrives in a bank account. The $500 million in stock remains fully invested, fully exposed to future growth, fully intact. The only new line item is a loan, and loans, by definition, are not income. This is the product known in private banking circles as a securities-based line of credit, or SPLOC. Private banks compete fiercely to offer these to their wealthiest clients, often at interest rates lower than a typical mortgage. Because the bank's risk is minimal, the loan is fully collateralized by liquid, publicly traded stock that can be sold instantly if the borrower defaults. For the bank, it is a low-risk, high-margin relationship. For the borrower, it is access to capital without the tax event. Everyone in the room benefits except the tax authority, who never gets a seat at the table because no taxable transaction ever technically occurred. And how do you repay the loan? You don't, not in the way you might think. As your assets continue to appreciate, you borrow again to service the first loan, or you wait until death, when heirs receive a stepped-up basis on inherited assets, effectively resetting the capital gains clock and erasing the tax liability permanently. This is worth sitting with, because it is the single most powerful piece of the entire mechanism. Under stepped-up basis rules, when an asset passes to an heir at death, its cost basis, the number used to calculate capital gains, is reset to its current market value. The decades of appreciation that occurred during the original owner's lifetime simply vanish from the tax calculation. If the heirs eventually sell, they are only taxed on any growth that happens after they inherit it. Combine that with a lifetime of borrowing instead of selling, and the result is a strategy that can, in principle, allow an enormous fortune to pass between generations, having paid close to nothing in capital gains tax at any point along the way. The loans are settled from the estate. The stepped-up basis erases the embedded gain. The cycle, for the next generation, can simply begin again. This strategy even has a name in financial circles. It is called buy, borrow, die. It is entirely legal, and it is inaccessible to anyone without a significant asset base to pledge as collateral. That last point deserves emphasis, because it is the quiet mechanism of exclusion at the heart of this entire chapter. A bank will not extend a securities-based line of credit against a retirement account with $30,000 in it. The strategy requires collateral measured in the millions, sometimes tens of millions, before a private bank will even open the conversation. The tool is not illegal for anyone to use. It is simply unavailable to almost everyone, not by rule, but by arithmetic. Debt is not the only tool. Real estate has its own architecture of advantage. When you own a property, the tax code allows you to deduct a portion of its value every year as depreciation, the theoretical wear and tear on a physical asset. On paper, the building is losing value. In reality, in most markets, it is gaining value. But the deduction is real. It reduces your taxable income sometimes to zero, sometimes below zero, generating what is called a paper loss that can be used to offset income from other sources. Walk through what actually happened in that example, because the mechanics matter. The property generated $800,000 in real, spendable rental income during the year. The owner could deposit every dollar of it. And yet, on the tax return, the same property reported a loss of $150,000, a loss that can be used to offset other income the owner earned elsewhere that year. This is the defining feature of the depreciation engine, the gap between economic reality and tax reality. Economically, the owner is significantly richer at the end of the year, richer from the rental income collected, and very likely richer again from the property's appreciation in the open market. Yet the tax code sees a building that is, on paper, falling apart, year after year, on a fixed and predictable schedule. Large operators take this further, with cost segregation studies, a process that accelerates depreciation by reclassifying parts of a building to depreciate faster. The tax savings can be immediate and substantial. Here is how that works in practice. Under standard rules, a residential rental building depreciates evenly over 27.5 years. But a building is not one undifferentiated object. It is wiring, plumbing, flooring, fixtures, parking lots, and landscaping, each with a genuinely different useful life. A cost segregation study brings in engineers to formally reclassify those components, moving a meaningful share of the building's value into categories that depreciate over 5, 7, or 15 years instead of 27.5. The effect is to front-load years of future deductions into the first year or two of ownership. An investor who might have spread deductions evenly across nearly 3 decades can instead claim a dramatically larger deduction, immediately, sometimes large enough to offset not just the income from that property, but income from other sources entirely, depending on how the investor qualifies under the tax code's rules for active real estate involvement. The total deduction over the life of the building does not change. What changes is timing, and in finance, timing is not a minor detail. A deduction taken today is worth more than the same deduction taken in year 15, because of what that tax savings can do in the meantime. It can be reinvested, redeployed, used to acquire the next property, the next loan, the next opportunity, all while the clock keeps compounding. The irony is architectural. The tax code rewards the behavior of the wealthy borrowing, holding, depreciating, and penalizes the behavior of everyone else, earning, spending, saving. It is worth pausing on that irony, because it is not incidental, it is structural. A teacher who saves diligently in a standard bank account earns interest that is taxed as ordinary income, often at a higher effective rate than the long-term capital gains the property investor enjoys. A worker who simply tries to set money aside is, in a very literal sense, taxed more aggressively on the act of saving than a real estate investor is taxed on owning an appreciating, income-producing building. The code was not written with malice toward the saver, but it was written, in large part, by and for the asset owner, and the difference in outcome reflects exactly that. Beyond individual strategies, there is the entity layer, the corporate and trust structures through which most significant wealth is actually held and managed. Operating through corporations allows the conversion of personal expenses into business deductions. Meals, travel, vehicles, real estate when structured correctly, these become costs of doing business rather than personal expenditures. The corporation absorbs the expense before tax. The individual benefits after. That distinction before tax versus after tax is the entire logic of the entity layer, and it is worth making concrete. An employee who wants to buy a car pays for it with income that has already been taxed. Whatever is left over funds the purchase. A business owner who structures a vehicle as a business asset, used in the course of legitimate business activity, can often deduct its cost before tax is calculated at all. The car is the same car. The difference is which side of the tax calculation it sits on. Multiply that single example across travel, home offices, health coverage, retirement contributions, and even certain entertainment and meal expenses, and the entity layer becomes less a single trick than an entire operating system, one where the boundary between the business and the individual is deliberately, legally, and carefully blurred in the owner's favor. Sophisticated structures rarely stop at a single corporation. Wealthy individuals frequently operate through a layered web of entities, a holding company that owns equity stakes, separate operating companies for distinct business lines, a management company that bills fees between them, and individual LLCs ring-fencing each major real estate asset. Each layer serves a purpose beyond tax, liability protection, so that a lawsuit against one property cannot reach the others, administrative clarity, so that income and expense streams stay cleanly separated. And yes, tax efficiency, since income can sometimes be shifted between entities in jurisdictions or structures with more favorable treatment, and losses in one entity can, within the rules, offset gains in another. None of this requires a single illegal act. It requires an accountant, an attorney, and the patience to set the structure up correctly before the wealth, not after. Foundations add another dimension. Transferring appreciated assets to a private foundation allows the founder to claim a deduction for the full market value without paying capital gains on the appreciation. The foundation can then invest those assets, generate income, and deploy it with the founder often retaining significant influence over how and where. Look closely at what happens in that transfer, because it is one of the most elegant moves in the entire playbook. Imagine stock purchased years ago for a relatively modest sum, now worth many millions of dollars. Selling it directly would trigger capital gains tax on the entire increase in value. But donating that same stock to a private foundation does something remarkable. The donor receives a charitable deduction based on the full current market value, and the appreciation itself is never taxed, not to the donor, not to the foundation, which is generally tax-exempt on its investment income. The asset has effectively been moved out of the personal estate. The tax bill on its growth has been erased entirely, and a valuable deduction has been generated in its place, all while the donor, sitting on the foundation's board, often continues to guide how that capital is ultimately invested and distributed for years or decades to come. None of this is evasion. Evasion is hiding income illegally. This is avoidance working precisely within the rules of a system that was designed, in many cases, by people who benefited from these exact same rules. It is tempting, after hearing all of this, to treat it as a checklist: borrow against assets, depreciate real estate, layer entities, fund a foundation, as if the only missing ingredient were the will to try. But that misses what actually keeps this door narrow. And it is worth being precise about it, because the barrier is not legal, it is structural. Every strategy in this video requires one thing: the tax code itself does not provide a large, appreciating asset base to begin with. You cannot borrow against stock you do not own. You cannot depreciate a building you cannot afford the down payment on. You cannot fund a foundation with appreciated shares you never had the capital to purchase in the first place. This is why these tools are, in practice, inaccessible to most people, not because of a rule that excludes them by name, but because each tool has a collateral floor beneath it, and most household balance sheets simply never cross that floor. The strategies are not secret. Banks publish their lending criteria. Tax attorneys advertise their services. The information is, largely, public. What is scarce is not the knowledge. It is the asset base required to make the knowledge useful. There is also a second, quieter barrier: time. Many of these structures compound their advantage across decades, even generations. A foundation funded today shapes a family's tax position for 50 years. A trust established for grandchildren can defer and redirect tax consequences across a span no single individual's career could match. Wealth that has had 3 generations to compound, structure, and shelter itself behaves very differently from wealth earned and spent within a single working lifetime, even when both started, at some point, from comparatively little. None of this is stated to suggest the system is impossible to engage with at a smaller scale. Cost segregation studies exist for owners of a single rental property. Securities-based lines of credit exist, at smaller scale, for investors with 6 or 7 figures in a brokerage account, not just 9. Even a modestly funded donor-advised fund can replicate a sliver of the foundation strategy. The architecture scales down. It simply does not scale down to zero. The top 1% are not avoiding taxes because they have found a bug in the system. They are doing exactly what the system was designed to allow. The real question is not whether this is legal. It is. The question is whether the system that made it legal is serving the same people it was built to serve, and whether the people who work hardest inside it understand the rules they are playing by. Most don't, not because they are not intelligent, but because no one ever showed them the manual. And the manual, once you have seen it, is not particularly complicated. Hold assets instead of selling them. Borrow against value instead of realizing it. Depreciate what is appreciating. Structure ownership through entities built for exactly this purpose. None of these ideas requires genius. What they require is capital, patience, and access to advisors who specialize in exactly this kind of architecture, 3 things distributed far less evenly than intelligence or effort ever are.